Welcome to Retirement Unlocked with Larry Heller. Your life, your way, unlimited possibilities. Join us as we explore how tailored financial planning and investments can help you navigate life transitions with confidence. Let's dive into this week's episode.
Hello and welcome to another Retirement Unlocked podcast with your host, Larry Heller. Today, top retirement tax pitfalls to avoid with Rob Premselaar. Okay, so Rob is the owner of Premselaar CPA, a full-service accounting firm that specializes in tax and retirement strategies for business owners and high net worth individuals. His career spans from roles at KPMG Merck and as a partner at a prominent, I'm making up words, CPA firm bringing deep expertise in complex financial and regulatory matters. Rob combines big firm experience with personalized service to help clients navigate critical financial transitions with confidence. All right, Larry, take it away.
Thanks, Matt. Rob, thank you so much for joining us. As a former CPA, I always love talking to another CPA, especially on a very important topic in taxes and retirement, because a lot of people don't even think about taxes when it comes to retirement. They just figure out how much money that they need. So let's kind of jump right into it, Matt. So sure. What are the most common tax pitfalls that you see when retirees begin?
Well, first off, thanks, Larry. Thanks for having me, Matt. Thanks for kicking it off. So one of the biggest pitfalls I see is just underestimating how taxable retirement income is, right? So people have traditional IRAs or IRAs. I like to call them IRAs in the business. They have Roth. Most people have heard of both, and they also might have deferred compensation plans. A business asset could be a retirement plan in a way, and just understanding how the tax consequences will play out when they start drawing on that income.
Yeah, I would think there's a few different areas when it comes to that people kind of need to keep, be attuned with. One that comes off the top of my head is kind of Social Security. So why don't you kind of talk about how that plays in on taxes?
Yeah, so Social Security, the basic rule is if it's your only source of income, that Social Security is not taxable. You don't need to even file a return. I would suggest still filing a return, just so at least that there's something on record. But the more income that you make, the more of your Social Security benefits becomes taxable. The most amount of Social Security income that is eligible for tax is 85%. So that doesn't mean it's an 85% tax. It means up to 85% of your Social Security benefit is eligible for taxation. And then we combine all your other income, deductions, et cetera, and the IRS imposes a tax rate on it. So the threshold is about $35,000 when the Social Security starts to become taxable. And another thing about Social Security income benefits is all states do not tax Social Security benefits. And so a lot of times when we project income, for all sources of income, we consider all types of income, but Social Security benefits are not taxable at the state level.
Right. So one thing to let our audience know, we're recording this June 2025 before any new tax bill that comes out. So I don't know if there's even any thoughts of changing the Social Security, but just in case you want to just check after there's a new tax bill that's finalized. Any thoughts on that, Matt? Rob?
If you follow this week in and week out, you can go, it flops back and forth. We've had so many changes in the tax laws these past 7 or 8 years. I'm waiting for it to become final. The House and the Senate and the Republicans, Democrats, they keep negotiating on things. There are some things I'd probably bet that are going to happen, but for right now, let's just focus on what is law. And then you could always invite me back, Larry, once the big beautiful bill does get finalized, because there will be planning opportunities both for retirees and a lot for business owners as well.
Right. So let's talk about one of the ones that is kind of right now here, and it's an extra kind of tax. It's kind of the IRMAA, the extra tax you have to pay on Medicare. Can you kind of let us know kind of what that is?
Sure. So the IRMAA is essentially a surcharge. It's a tax, a surcharge that is based on the last filed tax return. And when you are claiming Medicare, or when you are claiming Medicare, depending on your tax return filed and the income reported on that, Medicare will come back and say, we're going to charge you X dollars more on those Medicare benefits that you receive. So you won't get probably notified for at least a year after that tax return is filed that your surcharge has increased. The max actual increase can be up to $500-$600 per month. So it can be quite expensive. What we can do, what the government does offer, it does allow for an appeal process. So let's say your income is fairly steady, and in 1 year it spikes for a business sale, or you took an IRA distribution for whatever reason. Let's say you hit a big scratch off and your income spiked. The IRMAA, you will be imposed an IRMAA surcharge for that particular year, but then you're allowed to appeal that and say, for X, Y reason, change in circumstance, change in financial circumstance, change in life circumstance, you can appeal that IRMAA surcharge, and there is a formal process and application to do that.
Right. And I believe for joint filers, the standard is anything less than 212,000, and then above that, there's different breakpoints going all the way up to, I think, $750,000, where you hit your highest IRMAA.
Right, and that's for a married married couple. Single, it starts at about 106 of the IRMAA surcharge, and then anything above $500,000, you would be imposed a surcharge.
The funny thing is with IRMAA, because I get it now, and I don't care how much money that you have if their income goes up because they made more money, or we'll talk about kind of requirement minimum distributions later on, and they get this surcharge, and they're like, what's this? All of a sudden, I'm paying more from my Medicare. I didn't know about this. So it's kind of one of those things that a lot of people kind of don't know about until they get a letter saying that you're going to get less money because of this surcharge.
Right. And it's typically notified a year after the return is filed. So you might have experienced a spike in income, then you come back down and you're thinking, all right, my income has been reduced for whatever reason. And all of a sudden you're retroactively they're looking at a return from over a year ago, and they're imposing that surcharge. And then they're going to impose that surcharge via reduction of your Social Security benefits. And so why are my monthly benefits hence reduced? And it's because of those reasons.
Right. And then not that we kind of look at this to save money on IRMAA entirely, but if you get to the end of the year and you think you may be close to one of these breakpoints, you may want to consider kind of, something that maybe can minimize what's that's going to be. So that's some of the planning ideas that could be done along those lines. Yeah.
Other than income tax, the IRMAA surcharge planning opportunity as well.
Right. So let's talk about some of the other pitfalls. Any other pitfalls for that you see for retirees when they start to get to that point?
Yeah, it's understanding the RMD age. When do I have to start taking my distribution? Several years ago, Congress passed the law that increased the RMD age from 70 to 72, and now from 72 slowly creeping up to 75. That you don't need to start taking your RMD, your distribution that is that the minimum distribution that you're required to take. So I've had clients that have missed, right, or their financial advisor did not notify them, or they didn't know themselves that they had to take an RMD, and there actually is an excise penalty on that. To abate the penalty or that excise tax, there is a procedure to do that, and there is a fairly good win rate on that, but you do need to abate that penalty and abate that excise penalty. Another one is not understanding your charitable options in terms of taking IRA distributions. You can if you're very charitable, you can take an IRA distribution and set it aside for a 501c3 organization. Does two things: allows you to give a charitable donation, and will not require you to pick up that IRA or that retirement plan income for that particular year.
So you're talking about a QCD is what you're
referring
to.
QCD, right.
And you can only do the QCD when you're eligible for the required minimum distribution. Is that correct?
Correct. Right. So if you have other income to live on, but you have to take the RMD, you can satisfy that RMD by doing the QCD, just like you said. Yep. And then also it's just overall poor timing of when you take the money out, right? So we're looking at your needs, right? And that's where we bring in a financial advisor. What are your cash flow needs, right? And then from what account do we take it from? Do we take it from a tax qualified account, which would be taxable? Do we take it from a Roth account? Maybe you take it from a non-qualified, a brokerage account. And so mending your cash flow needs with the character and understanding the character of your accounts, retirement and non-retirement, is really what you should be looking for. And when you don't, is a major pitfall.
Right. And you make such a great point there, because now if you combine the two with the RMDs being pushed back to 73 and maybe 75, and if you retire at 65, you may have like 10 years where you've got possibly lower brackets. So you may want to take some money out of your non-qualified accounts rather than waiting for your qualified accounts to grow. So, we kind of call that the donut hole. We'll talk about some of the other planning options you can do during those years. But those 10 years are critical to really understand what your tax brackets are going to be and figure out how you go there. Do you go into that with your clients?
Yeah, totally. We do, and the general rule, people think, my income is going to be less in retirement. Well, not for everybody, right? I mean, what if you're selling a business? What if you have a buyout of some sort? It's not a guarantee that your income is going to decrease in the future. For somebody like me who has a little bit more time, before they start thinking of those RMD ages, who knows where the rates will be in the future? Who knows what my income will be in the future? So, the general rules, again, income will be lesser in the future, but who knows, right? Hopefully it's not, right? But for most it is, but not for everybody.
Right. So it may make sense to pay a little bit less tax and avoid a lot more tax later on. So it's really critical to try to plan this kind of forward seeking and then kind of revise it year by year. So that's why it's so important, for us as a financial advisor to coordinate that with your accounts so we can make sure that you pay as minimal amount of taxes as possible.
Yeah. Sure.
So I think you mentioned one thing before, but let's kind of talk about some of the retirement tax planning pitfalls for business owners.
Yeah. So again, it's not planning for the impact of the exit, right? So there's many different ways that you could structure an exit. You could structure an exit or a cash payment down. You could structure it as an installment sale over X number of years. You have to understand the nature and the character of the income. It could be ordinary income or capital gain income. So all that needs to be considered when properly setting up an exit strategy for when somebody is going to be in the midst of retirement during that exit.
Right. So then how can business owners use their retirement plans to maximize their savings before they even retire?
Yeah. So this is probably one of the most effective tax saving tools. Simplest, simplest, most straightforward, probably one of the easier to understand is being able to contribute to a plan today. I call it a cocoon, right? You put it in an account or a cocoon and you're going to put it away to the future. A lot of these plans provide you a tax deduction today. So that you can draw on it and pick up the income in the future. Now, which plan is right for you, right? Which plan is right for this particular business owner? Many different factors: number of employees, your income, your needs, your tax bracket. So there's a whole slew of menu options where most people think, oh, my 401k or my IRA. Well, there's a lot of bells and whistles when we come into each of these plans that you must adhere to, right? The Department of Labor, it's not the IRS, right? Well, it's kind of the IRS, but the Department of Labor has certain rules that you must stay within, a lot of guidelines, and if not, that's a major breach. So things such as a solo 401k, SEP IRA, cash balance plans, you can contribute really anything from these plans I listed from $6,500 all the way up to $300,000. Now, not in each of these plans, but in the right plan, and you can pick and choose different bells and whistles and different attributes, you can set up the correct plan that's right for you, which requires a lot of planning. It requires your financial advisor, likely requires an actuary that's on board. But the moral of the story is there are options out there. There is no one size fits all. All these professionals, along with your CPA, can assist you in making that right determination.
Right. You mentioned one there. I mean, we do a lot of these types of plans of putting in place, and you mentioned all the 401ks and the SEPs. But the one thing that we see a lot of people don't really understand, and there are certain parameters that you mentioned. One of them is also age and your census, but is the cash balance plan, and able to, in a lot of cases, able to sock away a lot of money for those that are making a lot of money. And it doesn't work for everybody, but it's something that you should really be aware of. We've had situations where we've come to, and they had their plan with their payroll company, and we looked at it and we said, you can put away an extra $250,000 tax and get a tax savings from it. And they had no clue. So for those of you out there that Rob's talking about, that cash balance plan, it's something you should be asking your accountant, asking your financial advisor. Is this something that will work for you if you're able to put away some significant dollars? Right.
And one other thing I want to mention is everybody says tax deduction and they assume federal and state. I'm out of northern New Jersey. I know the New Jersey tax laws in and out. New Jersey does not provide a deduction for IRA contributions. So that's a traditional IRA and a SEP IRA. You take that.
What's with that state, Rob? Come on.
You have no idea. Every line item is different.
There's some other things there, right? We can talk about it. They don't do tax loss carry forwards either. So,
it's considered an income state. So everything on the front of the tax return is all positive income. They don't allow any negatives to flow through. So take it, for example, you're deciding between a certain retirement account, a SEP IRA, and a solo 401k. So it acts almost entirely the same way, but a solo 401k, because it's a 401k, the contribution to it does provide a deduction on a New Jersey tax return. So if you're most people are 6.37% rate, but if you're upwards of 10 or 11%, just changing from a SEP IRA to a solo 401k provides you that incremental tax deduction. Now, if you're in other states, most other states do provide a deduction for the IRAs. But solo 401k, I kind of lean a little bit. I like a little bit more for New Jersey business owners because of that incremental tax deduction at the state level.
Great point. That you have to worry both your federal, state, and your state taxes. So one other thing that I just want to kind of let everyone know, I mean, it's not really just for a business owner, but something new and ways of saving for retirement is the super catch-up, the enhanced catch-up. You want to just talk a little bit about that?
Yeah, I don't do too much of that. I mean, is there something that
yeah, so I'll kind of just do that. So for your age 60 to 63, you're now able to put away more than your age 50 catch up. I think we did a whole podcast on that. So just something to be, if you're talking about saving for retirement and saving some taxes, that the government has got a little bit of a little kicker that you can do for those 3 years. It only can be done for those 3 years. So don't miss it if you're in that time frame.
Yeah. One other thing I kind of like to explain to business owners when they're considering retirement plans, certain retirement plans, like a traditional 401k, that if you're a W-2 earner, those contributions are cash basis, meaning if you want the deduction, let's say in 2025, you need to make that deduction from your W-2 paycheck by a paycheck that's dated 2025. For other retirement plans, for business owners, SEP IRA, and solo 401ks, you actually have the ability to accrue, meaning take the deduction on your 25 return, but you have until April, September, or even October, depending on your retirement plan and the type of file that you are. So you take the deduction on, let's say, your 25 return, and you don't actually have to cut the check to that cocoon, we call it, to that retirement plan, potentially until 9.5 months later.
Right. It's a great point. And actually, go one step further. They changed the rules now that if you haven't done some retirement plans for 2024, you can actually create those now in 2025. You can't do some safe harbors, but there are some plans that you can put in place that you can actually put in place now for 2024. So it's not too late for 2024 if you haven't filed your tax returns yet. So, so let's kind of, talk about, some of the pros and cons. We talked about some of the ideas on how to save money. And one of the things that you can do to look at is Roth conversions. So, what are the advantages, the disadvantages of doing a Roth conversion?
Yeah. So the advantage is your money is sitting in Roth. What is Roth, right? What are Roth dollars? Roth dollars, it allows your account to grow tax-free. When you take the money out, your corpus, your principal, your contribution plus the growth, when you take it out in retirement, is not subject to income tax. Very powerful, very, very powerful tax tool. One thing I really like, probably the strongest character of a Roth is, because the money is all post-tax money, is that you're not required to take a minimum distribution. You don't have an RMD on that Roth money. So with the traditional account, the IRS is waiting for their tax on that income that's appreciated, or you've taken the deduction on as well, and they're waiting for you to take a distribution and pay the tax on it. That's why they require a minimum distribution, an RMD. Roths don't have an RMD, so the IRS cannot tell you when the timing of that income needs to be distributed. Now, a really good estate planning tool is when you, I hope the day should never come, but when you should pass away, your beneficiaries inherit the account with the same character as the account owner. So when your beneficiary were to inherit an IRA, let's say a traditional IRA, if it's a non-spousal beneficiary, a child, a friend, what have you, that beneficiary has to take the account out, deplete it over 10 years from the 10th anniversary of the date of death. But if it's a traditional IRA or a traditional account, it's all taxable. A Roth, again, same rule, that it needs to be fully depleted by the 10th anniversary of the date of passing of the original account owner, but there's no tax on it. It's a very, very strong asset building wealth transfer mechanism. So I think that to be the strongest benefit of a Roth. Now, the con, it's expensive, right? For you, if I have to tell a taxpayer, look, you could put X dollars into this cocoon, but you can't touch it. You could always but subject to a penalty. You're not getting a deduction on a Roth. It's expensive, right? Why not put my money and have liquidity in a regular checking account or a regular brokerage account? I can touch it and not be subject to a penalty. Sure, but the asset potential and the growth potential and the tax savings potential is not the same as a Roth. So that's the major con, is that frankly, it's expensive. And I totally understand when clients, don't want to put money aside and pay the same tax as they would have been without the deduction.
Right. So you're talking about annual contributions, but what about you've accumulated a lot of money in your IRA, and now maybe should you convert that over to a Roth? What we find here that, most CPAs don't like recommending to pay taxes now, but what are your thoughts on that?
Yeah, look, if you're in a lower tax year, for whatever reason, business is down or lower W-2, and you have money sitting in a traditional IRA, it could make sense to fill up that tax bracket. And that's what we look at. If you're in a 12%, 22%, 24%, where you're projecting to be in a 35 or a 37% bracket in the coming years, and then in retirement, let's fill up that gap. A lot of times we look at that with beneficiaries. When do we want to deplete the account in terms of timing over the 10 years? But that same theory and the same math makes sense for income, in just regular your regular earning years. So that's what we look for. If you're in a higher income bracket, does it make sense to convert to a Roth? But when you're typically in the lower income years for a one-off, let's say, it makes sense to fill up that tax bracket.
Right. And we actually look at what I mentioned before, those years when you retire before you're receiving your requirement distribution, because I kind of call it the donut hole. There may be a lot of years where in your lower bracket, and if you don't plan and you don't think about it, like you said, when you have to take a requirement distribution, you can be kicked into a much higher bracket. So planning and doing those years, doing it together with a financial advisor and accountant can try to do that. And we show people that Roth, like you had mentioned, if you're doing a Roth conversion in your 60s and you're going to live into your 90s, the appreciation of a Roth account growing that either you could take it out later on or your kids would be a huge amount of savings. So I think that's such a critical factor in planning for retirement that you mentioned.
Mm-hmm.
So Rob, you kind of mentioned, I think Matt mentioned in the opening that you worked at a big firm. In my previous life, I did as well. So how does the background of working at a big firm help you now with your own practice?
So I say that I grew up between the ages of 21 to 28. I grew up in KPMG in the audit practice, and I had real great experience working with Fortune 100 companies. I've seen the audit world. I've seen internal controls. I've seen business processes, and I'm a real auditor. I know the assertions, and bringing it to the small business environment where a lot of my clients might not have access to those types of professionals and that type of thinking really has lent itself tremendous value. I'm consistently just thinking outside of the tax box and just being a general business advisor. And because of my big corporate audit experience, that really is a big differentiator, I believe, in me providing my professional service.
Yeah, I couldn't agree with you more. I came up from the auditing side, just the way you think from an auditor, whether it's handling a business or even on a personal side, thinking as your kind of personal CFO, that training in there and the step-by-step training. And when you can relate to clients and this step, when I have new associates here, they just don't have that same thinking capacity that kind of was drilled into us when we training from the audit side. So I agree with you 1,000% on that.
And also, I mean, look, I also got a lot of my documentation skills, being able to draft letters, explain things in work papers. A lot of that, I actually give a lot of credit to my experience in the Big Four, because they drill down to you. If it's not documented, it's not done, right? So a lot of my skill sets now include the ability to document.
Right. Well, I won't tell you that I was with the Big Eight, so I was a little bit before your time. But any last minute thoughts, Rob, before we kind of close this out?
No, I mean, I think the moral of the story is know that there are options. Know there's not one size fits all. Know that your financial advisor and CPAs and financial institutions are trained on this type of stuff. When you're what I call cocktail talk, when you're out at a barbecue and you hear a friend or a neighbor or a colleague speak about what worked for them, could work for you. I don't know. You need to. Your situation might be different. Who knows what they have under, their belt, and what their account statuses are. But just know that reach out to a professional. We're here to help, and we're trained to.
Sounds great, Rob. If someone wants to reach out to you, where's the best way they can get a hold of you?
My website, PremselaarCPA.com. My email, rob@PremselaarCPA.com. We have a really good online portal where you can download a mobile app, message right into us. And then, we'll leave it at that. If you want to find my phone number, you could just give me a Google search.
Sounds good. Rob, thanks so much for joining us today.
Yeah, my pleasure. Thanks, Larry.
And we will make sure that we have all of those links in the show notes, so make sure that you click over there. So thanks for tuning into Retirement Unlocked. If you found this episode helpful, please like, subscribe, and share it with somebody who might benefit from this episode. But if you want to take the next step, in the episode description below, you'll find a link to Heller Wealth Management's website with more resources and the option to schedule a complimentary 20-minute call with the team. Your ideal retirement starts with a conversation, so let's get started. We'll see you next time on Retirement Unlocked.